Okay, everyone. Hope you're all having a good day. We'll go ahead and get started here. Um, I'll get into kind of macro catalysts in a little bit. I want to start off with cycles and kind of get into, my take on where this market uh, likely will be heading, just the scenarios that I see. And a lot of it's based off of cycles, just time scenarios. Now, this is work I've been doing for years, but I just started kind of revealing it and showing it to everyone really in 2025. Um, and if this is new to you, markets tend to follow set cycles, not specifically, but in a very general setting. Uh, this was work that W.D. Gann figured out, um, and has an eerie accuracy to it. He claimed the 60-year cycle, which was 60 years from today. The market tends to have this rhyming pattern, which, as you can see, going back, well, actually, no, I haven't set it up that way, but from 1962 to 2022, it's almost a perfect correlation to the 2022 drop all the way up to where we are right now. And if we look at what the 60-year cycle is saying now, um, which is, this was the centerpiece of all of Gann's annual forecast, was a 60-year cycle. And in my experience, this cycle or a combination of this cycle with other cycles tends to be what leads. But it's a very, very important cycle to track. And from my calculations, we should see another drop into sometime next week. There's a pretty big time factor coming up next week. Then a bounce into kind of mid to late April. And then it's saying we should see a notable drop into that October, September timeframe. Now, at the beginning of the year, I'll take all 10 cycles that I track and I just make a composite to kind of get a general idea of where the market might be going. But we have about, going on like 2.5 months worth of price data. And so that really narrows down the field quite a bit. And the ones that are tracking this market the best, which is this kind of overlapping controlled descent that we're seeing right now, is the 60-year cycle, the 45-year cycle as well, which also is showing some kind of a low into late March, bounce into April, and then volatility really begins. The 45-year cycle says it has it going into 2027. I'm not going there yet, one step at a time. But like the 60-year cycle, it's saying late March low, bounce into April, and then volatility really picks up. The 15-year cycle is tracking this market very closely as well. And it's saying the same thing, kind of a low into next week, maybe the week after, bounce into mid-April to kind of late April, and then volatility into the June, July timeframe. Though these cycles may disagree on when the volatility stops, they don't disagree on a bounce coming and when the volatility really begins. And that's what's really important. The other cycle, and this isn't a Gann cycle, but it's a cycle nonetheless. It's a 4-year cycle, the presidential cycle. And this takes us back into 2022. And it's lining up as well. Drop into next week, bounce into mid-April, and then volatility really picks up. And so if we make a composite of these cycles, here, got it like right here. Let's kind of do this. See if I can move this up. Yeah, there we go. Yeah, there we go. Right there. It lines up pretty well. That one more drop into next week, moving up into mid to late April, volatility really picks up into that October, September timeframe. What I find interesting about this is whenever I look at like the cycle windows, like the periods with this year to pay attention to, right now was one of them. This is the S&P 500, and these symbols represent cycles. And so what happens is, what matters is how are you trending into them? They tend to mark a reversal of the trend going into them, and it really matters when they cluster together, which is what we're seeing right now. We have a huge cluster, plus price is just hitting all these angles going back from like 1972 to 2002, just all these major angles are intersecting right now. So price and time is saying this is important. The next cycle I'm focused on here is kind of in June. And then the big one is going to be September, October. And if you think of it, and the other one is the NASDAQ 100. It topped here in October. We had a cycle cluster right here with the NASDAQ 100, and it hit this angle right here, and it hasn't made a new high since. And it is also showing a cycle that's pretty important in mid to late April. And so when you put that all together, mid to late April is right here, this bounce high. June is somewhere around in here, and then that October, September timeframe is around here. So anyway, that this is kind of the roadmap, the general roadmap that I'm following. If it starts breaking, then we'll kind of figure out what cycle's leading this market. But that's kind of what I'm looking at right now. I think that we're going to see some kind of a low into next week, if we haven't already gotten one, bounce into mid-April, maybe early May, and then volatility really picks up. And so this is one piece of evidence, but I've been going over this for a long, long, long time. And I'll kind of get into the S&P 500 right now. Um, what I did was I outlined all the time factors, all the cycles for this year. You know, the brown ones are the minor ones, the gray ones are the big ones. Um, and what I'm really focused on is how is the market going to trend in that September, October timeframe? And how it trends into that, I think, will be pretty important. But this is what I'm tracking right now. This is what I'm the roadmap that I'm following. I think we've topped. It's hard to say that this is some fourth wave and we're going to get a fifth wave higher, which is how extended this pattern is. So I think that we've put in a top. And so as you can see, this kind of controlled overlap, whether we get one more drop or not, doesn't matter. But we have a time factor coming up next week. I'm betting that we're drop into that and we'll probably hit that 6,500 range somewhere in there. And then we get a bounce up into that late April, maybe May, makes a lower high, maybe a double top, and then a bigger drop down into that September, October. The dimensions look off based on this, but as we've seen with the 60-year cycle specifically, that's exactly what played out. It had this drop into like, next week, a bounce into like the following month, and then volatility really picked up into like that October timeframe. So I'm not sure what the pattern will be. It could be some complex pattern. I don't know. That's what I'm hoping for, is that we get some kind of a low into that September, October, which will set up for a big rally into 2027. The other scenario, which is a little bit more symmetrical, if we trace just a standard corrective pattern, maybe some kind of a low now or next week, bounce into April, May, drop into that June time frame, and then we get a overlapping big bounce into October, September. If that happens, that means that the big top is likely in. Um, so getting a little bit ahead of ourselves, but right now, just to kind of keep it more into like what's happening right now. Um, Let me just do this right here. This is the roadmap. From the top, three down, three up, that's A, B, and then this diagonal for the C wave. One, two, three. Is this four right here? Or are we going to get one more, four right there, and then A, B, C, five into that 6,500 range, somewhere around in here. And that should be it. And then we get a bounce, a relief rally into April, May. The other scenario I'm tracking is that um, this or right here was the end of the A wave right there. This is A, B, and then maybe a C wave up into like next week, the week after. And then we're setting up a bigger drop right there. So we're just going to have to see what we get in terms of how do we trend into the coming cycles. But I think we're close to the end of this portion of the correction. And what's next should be some kind of notable bounce. Okay. Regarding the Qs, just to give you a bigger time frame, this pattern looks incomplete. I think it supports a drop into this year and then another high into 2027, which would complete a very large ending diagonal that started in 2022. One, two, three, and then we get our four, and then five into 2027. Um, we'll have to see how it plays out. My alternative scenario is that's all you get right there. And any kind of bounce from here is going to be a lower high, and then it really unravels. But what I find interesting about the Qs, like I said before, it topped in late October. the Mag 7 started topping in June of 2025, and just like dominoes, every single one has fallen, making lower highs against the S&P 500, which was making higher highs. Never a good sign when you see that. But look at this. You see this chop right here, and then all of a sudden volume just accelerates. I mean, look at this. This is the highest volume has been for the Qs since May of 2025, since we really started this move. You got to ask yourself, what's going on? Markets are going sideways, but volume is this elevated? And it is pretty clear when you start looking at what institutions are doing. These are block trades. For example, this single trade right here was $1.3 billion of the Q. We don't know if they're buying or selling, right? But institutions are either buying in huge bulk, $1.3 billion, either buying or they're selling. And what that means for us is that, excuse me, where am I at? Right here. If they're buying, then we'll see a catapult higher, a breakout on, a vertical move and just a move higher. They're basically accumulating for something. Now, if they're distributing, which is what I think they're doing, is they're keeping this market elevated and they're just dumping shares to retail or whoever's buying them, and they're going to drop it. And when they do drop it, first you'll break below 590, and then you're going to break below 5874, and it would be a pretty vertical move. Even with momentum this oversold, you got to understand just how vertical this move was. I mean, it was basically we were in overbought territory for, 6 to 9 months. So if we get into a third wave down, which is what this pattern would be, we break down and go vertical. You got to turn off the momentum indicators. They will hurt you because in a third wave, you stay overbought or oversold for a very long period of time, longer than you think. You can look at those momentum indicators and be like, oh my goodness, they're in the basement. This is definitely a buy, and then it just keeps going lower. And the setup is there for a third wave drop. So if we take a look at the Qs, following the red, that's three down, three up for B, 1, 2, 3, 4, 5. This overlapping mess right here. I'm thinking we get one more bounce into like next week, or maybe we get a drop, who knows? Or it just kind of just unravels. But the setup is there, five down, three up, and then you just break support, and it would be a third wave lower. So we'll have to see. But if it follows the S&P 500, what I'm thinking, then maybe we get one more slight drop that holds this support level, then bounce up into April, and then it unravels. But you might be wondering to yourself if you're new, like, why am I talking about markets unraveling? Well, we've been seeing markets top at different intervals for, 6 months now. These are markets that I like to track. Financial conditions, it's just a rough estimation of liquidity. It topped here in January 2025, and the S&P 500 has been pushing higher without it. Financials, this is big banks. This is your JP Morgans. They topped in January, clear topped, and just a vertical free fall, while the S&P kept pushing higher against it. Not a good sign. High beta, which was leading the market off the April lows, topped here in early October, and just completely got demolished. The equal weight Mag 7, which are the bull cycle leaders, they topped here in late October, and the S&P kept pushing higher into January without them. Small caps topped about a week before the S&P 500. So you're seeing these divergences, right? Which is never a good sign, especially when your market leaders like the equal weight S&P 500, financial. People could think things like, oh, this is a healthy rotation, right? You're just taking gains from the Mag 7 that treated you so well, and you're rotating it into your value names or names that will do well and based off some macro conditions in the US economy. Well, why is financials collapsing? Huh? That doesn't make any sense. And then you look at these markets that kept pushing higher while the S&P topped, industrials, just a complete sell-off. It's basically on its last leg. If we take a look at industrials, which by the way has nothing to do with technology, right? Which I think everybody inherently understands that. But the pattern off the April low is incredibly complete. One, two, there's your third wave, right? Vertical move higher. as volume goes higher and momentum reaches its peak, this congestion for four, and then your fifth wave move, price goes higher with less volume and less momentum, clear five wave signals. But take a look at this. Just the fifth wave alone, one, two, three, four. That's a four right there because it's a triangle pattern. They only show up in B waves and fourth waves. And then five. And this fifth wave up happened on even less volume and less momentum. And now we broke support. The only other scenario you have to push higher is to say this is a very rare extended fifth wave right here, and you just push this wave 5 of 5 out a little further. But once you break below 163.18, that's not going to happen, right? So risk is extremely high that industrials has already topped. You take a look at another market like transports, which just caught a sign of life out of nowhere, right? And it kept going higher when the S&P topped. Well, it just completely fell off a cliff as well. And I look at that pattern, and the pattern I was tracking that made the most sense broke, which means that the top was in. The only other pattern I can give it would be that this is your A wave, this is your B wave, and the C wave is this pretty crazy diagonal pattern. One, two, three, here's four, and then we get a fifth wave higher. So you get one more swing into like April, May, which would complete this very large pattern right here. But if we break below $70, then transports have topped too. These aren't tech sectors, you know? So anyway, like I said before, the Mag 7 have all topped. Not all of them, but you're like Microsoft, Amazon clearly have. Apple's on its last leg. I think Avgo has. Nvidia is just treading water, and we're waiting to see what kind of move it makes. But and Google, I think, has as well. So anyway, and it's not just in the US. If we start going to international markets as well, like the Nikkei, for example, had a big move lower. Look at this move off of the April low. There's one, two, there's three, max volume, max momentum. Price went vertical. Four right here, and then price moves higher with less volume and less momentum. And this fifth wave is complete. One, two, three, four, five. Big drawdown. It broke below this four, which tells me it probably topped. So any kind of bounce would be, corrective. And then we start breaking these supports here, and then the Nikkei's topped. That's not good. You look at the Chinese, the Shanghai SSE composite. We look at this pattern since we're going back to the 2007 top. Look at this triangle pattern. A, B, C, and then here's D. We're coming right up on that trend line in a complete pattern. There's A, B, 1, 2, 3, 4, 5. Do we get one more swing higher? I don't think it really matters in the grand scheme of things. Maybe we get one more move higher, but as I've been saying, is like we're probably going to bottom and get some kind of a bounce into April, May, and then it'll become apparent to a lot of people who aren't tracking this stuff. That's what I think. So maybe China in that April, May timeframe can get one more little high and touch that trend line. But I mean, just look at this pattern. Is this something you want to go along with, But my point is, why am I talking about China? Markets are all interconnected and they all give off signals at different times. The German DAX tends to top before the Canadian TSX, and the Canadian TSX tends to top before the US markets, but they all kind of communicate. And if you look back even in 2021 and 2022, I mean, these global markets were topping in mid 2021 all the way up into the 2022 top. And so that's why I'm looking at them. You look at the Canadian TSX, for example. I've been talking about this for a while. I don't think it's topped in a big way. I think we're going to see a fourth wave and then a fifth wave higher. But finally, the internals are in a place where you tend to see tops. You see three lower highs in the momentum as price makes three higher highs. And we found a top at this key spot right here on the RSI, and we started seeing volume pick up to the downside. It goes below this level 31,726. The Canadian TSX is put in a high. But these are topping patterns right here. So maybe we get one more high, maybe not. Doesn't really matter in the grand scheme of things. The German DAX, we've been following this one for a while off the April low. 1, 2, 3. Huge congestion for 4. 1, 2, 1, 2, three, four, what? Five? The fifth wave didn't exceed the third wave. That's called a truncated fifth wave. And when that happens, you tend to see a very large decline in the opposite direction. The last market that I've seen do that was Microsoft, which is right here. Off the April low, one, two, three, four, five, did not make a new high. And we saw a 30% drop in one of the seemingly safest, biggest, most exciting companies with an AI trend. That's what happens when markets truncate. And the German DAX just did that. So anyway, that's not good. And you go along the lines, the Indian Nifty 50. I've been tracking this market for a while because it's been leading US markets. It's been leading in a pretty big way. I put it as topping. So off the March low 2020, one, two, three, four, five. And what got me is this. See this move off the low? One, two, three. It's a three-wave move. So what that would be if it was bullish is one, two, one, one, two. But this drop right here went below the start of what this would be a first wave. So that tells me that, that's probably a B wave. That means it topped right here. And furthermore, the RSI is below the bullish support, which has really kept this market in check since 2020. That's not good. And so the Indian Nifty 50 looks like it put in a top in as well. The silver lining I see is the Kospi, the South Korean market, which, believe it or not, is 45% Samsung and HK Hynix. So its long-term bullish pattern is actually quite interesting. But this move that we've been in, really since late 2025 to now, is clearly some kind of a third wave. I mean, just huge volume, momentum peaked in a big way, vertical price movement. Based off the pattern, I think it's three. We should get a fourth wave decline and then a fifth wave higher, which lines up with the AI trade in 2027. Though we'll probably see, markets top now and into like probably mid 2026. We will see other markets, I believe, probably top in early 2027. And they won't be in some secular top. It'll probably be in some kind of a huge fourth wave, whereas the Kospi would be some big B wave. So it'd be a big correction within an even bigger uptrend. You can't say that about a lot of sectors like financials and industrials and, non-AI tech related from what I could see right now. So anyway, now you can kind of see why I'm talking this way is it's not just the US, it's not just tech. We're seeing markets top after completing very large five-wave patterns into meaningful cycles. And if we look at like what these cycles are telling us going into 2026 and 2027, it's not pretty. It's not good. Major cycles are all pointing lower into 2026. And so I think the idea that we would just find a support and just break out and have another 2025, April 2025, I don't see that. And if we see all these divergences correct, like for example, the Mag 7 all correct and they break out to new highs and financials break out to new highs, if we start seeing that, then I'll change my tune and we'll put the cash we have into these markets and just ride it higher. But these are more stark warnings than I saw in kind of late 2024, early 2025, which put us into a lot of cash and got us into a pretty good hedge for that drop. I haven't seen divergences of this caliber in a very, very long time. So I consider it a warning. I really do. When we look at like the macro landscape, I've been talking about this. This is something I think everyone should keep an eye on. You know, we are in the AI economy. And if you're on Twitter, you're seeing people like Elon Musk and, the CEO of Anthropic talking about like all jobs will be gone and, I mean, just absurd things. I just that kind of stuff. You just, we're in like the part of the tech trend that's called like the hype phase, where no one really knows where it's going to go, and there's all kinds of wild beliefs on where it will go. And the thing about AI is it's kind of scary where it will go. And while I think there's some truth to that, we can also look at history to see how this played out. So let me tell you what I mean by that. So if we look at job openings in the private sector from March of 2022, it's down 50%. Now, that's huge. We saw a drop from the November 18th high in the private sector jobs, to the COVID low was 43%. But during that time frame, corporate profits fell down 19% and the S&P 500 went down like 30 something percent. What's unique about this time frame is private job openings are just not there. They're gone. And what's happening is corporate profits are skyrocketing, and investment in equipment and companies' businesses is also skyrocketing. That's not normal behavior. And what that tells you is that companies are adopting AI tools at a very fast pace, and they're seeing their profitability go higher, and there's no need to offer private jobs. Now, here's the thing, unemployment has not increased, but if and when there is some weak spot, let's say oil stays elevated 90 to 100 for another month or so, that's going to cause some pretty big problems, problems that will probably not be easily reversed. And you could start seeing, unemployment go higher. And if that does happen, if we go to some recessionary environment where unemployment goes higher, there's no cushion to catch people like there was before. And that's kind of alarming that this pattern is happening right now. Now, you may look at this and be like, oh my God, this is the Armageddon scenario, and we've never seen this before. We have seen this before. This is what happened in the 1920s and 1930s. Instead of there being one technological advancement like AI, which is meant to displace a lot of workers for today, we saw multiple technologies in the 20s and 30s. I mean, things like the telephone, like farming equipment. You saw the assembly line, for example, and all these technologies kind of hit in this decade, and businesses started adopting them. And you think about it, businesses are doing what's best for their business, what's best for their shareholders. They're not talking to one another; they're just doing what's best for their business. And if that means that they can improve their margins by this much, and let go of labor, which will improve it even more, and they'll be more efficient, then they will pursue that individually. And if enough businesses do that, then it creates a scenario like this. And then if and when the market and economy gets weak, there's no one to catch them. And all of a sudden you're looking at very high unemployment, and there's no one left to buy these businesses cheap goods. And you saw this in the 20s and 30s. I mean, you saw like Henry Ford. I mean, we're doing a report on it, so there's all kinds of data, but like they started in their attempt to improve their margins, they somewhat created an environment where unemployment went through the roof and there were no jobs for anybody, which means there's no one to buy their stuff. And their businesses started to get hurt in a very big way and stayed that way for some time. Now, I'm not likening this to the Great Depression. The Great Depression, there are many factors involved. Government intervention was probably number one of what caused it. But this dynamic is not new, is what I'm saying. If this is the only time in human history where AI doesn't create more wealth and more jobs, it'd be the only time in history that technology has not done that. We can't see where it's going to go right now, but right now, this dynamic is setting up for a painful transition as the changes are happening probably faster than the economy can absorb it. And so just keep that in mind. If we start seeing unemployment ticking up to like 4.5, 4.6, if it gets to 5%, it could really be a nasty situation. So anyway, that's probably the most important dynamic I think going on right now in the macro world. Doesn't mean 2020 is going to be a 2026 problem. It could be a 2027. I don't see it being an immediate problem unless, we start moving into some kind of recessionary event, some kind of shock recessionary event that just happens. The other thing that I find worth noting is DXY. This is the US dollar. It is an indirect proxy to track global liquidity. I don't mean market liquidity, I mean economic liquidity. How easy is it to borrow, to roll over debt, to acquire collateral for debt? The higher global liquidity is, the easier it is to do those things. The US dollar is probably the most important factor in global liquidity because of so much of global debt is denominated in US dollars. So the higher the dollar goes against other currencies, that means that the more that person holding the debt has to come up with their own currency to service their US denominated debt, which means they have less money to buy Bitcoin and risk assets and things like that. So We want DXY to keep going lower. The problem with that is that the Elliott wave pattern, which topped in 2022, is A, B, so 3 waves down, or actually more like 5 waves down, and then 3 waves up. And then the final C wave is clearly 1, 2, 3, 4. And then best case scenario is this is an ending diagonal that will take you down to like October. So 3, 4, 5, right? But I've had to change this. Even though DXY be going down, global liquidity goes up, which is good for the risk assets. So I call it the bullish count. Um, I had to change it already because of how big this move was off this low here in January. If DXY breaks above 100.4, then this green count is off the table, and we're looking at best case scenario, something like this, a multi-month uptrend in the US dollar, which would be very bad for risk assets. This is something most people are not factoring in. If you look at macro data, all the forces and narratives behind DXY says the dollar should continue to go lower. And though I think that will happen in the distant future, based off this pattern completing, if we break above this level, it's not probably not going to happen. I think it's going to shock a lot of people. This is something to keep an eye on. What would cause the dollar to go higher? Fear events, usually, or what triggers that. I mean, the US dollar and treasuries are typically where people hide when uncertainty suddenly hits and you need to put your money in a safe spot. So that would be that. The other scenario worth tracking is going to be, let's see here. Where is it? Right here. Yeah, it's actually on this chart. Nope. Where is it? Is it on this one? Oh, it's on this one. TLT, long dated bonds. Okay. Now, nobody wants to own a fixed yield when inflation is going higher. Who wants to own a 20-year yield at like what 3.5% if inflation is, tracking at like, 3.8%? That means you're guaranteed to lose money. So this would become a problem because no one wants to own a long dated debt instrument in a structurally inflationary environment, which means that bonds have to go lower, yields go higher in order to find those buyers. The problem is we have so much debt that we can't afford for yields to go higher. And so if this red count plays out and we start breaking down, you could easily see the Fed step in and do yield curve control, which I think is a guaranteed. I don't know if it's going to happen this year or in the next 5 years, but you will probably see the Fed at some point do yield curve control. There's no other option. And for those that think that like that, all the debt in the US is just gonna, it's gonna happen right now, these things can go on for a long, long time. The Fed's balance sheet is massive and it has a lot of room to absorb this insanity. So this is nothing I would be betting on right now. But anyway, here's the pattern. Ever since the war started and we're spending money and there's no end in sight, the bond market doesn't like it and it's now on major support. We start breaking below 86, 84, 83. That's going to be a big problem. That'd be a really big problem. You're going to start seeing the bond market start dictating probably US geopolitical policy. The bond market actually forced the Fed's hand in 2024, and it forced the executive branch's hand on 2 days after Liberation Day. They both reversed course because the bond market said, no, we're not going to allow this, for better or worse. And so the bond market is the 800-pound gorilla in the room. It's been trading sideways for a very long time, and these are your supports. We break below here, that's going to be a shock to a lot of people, especially risk assets. If we break out above $92, that will actually be relief to risk assets until people start realizing why bonds are going higher, which is probably a growth concern. So these are the markets that I'm tracking right now just to see what's going on. Wow, that's a huge reversal of the skew. Anyway.